Crazy. All right, but we are streaming, so those of you on YouTube should now be seeing my face as well. Lucky or unlucky for you. And just to kind of reiterate, we're going to go through a couple things today. It'll be very specific today because we're going to cover not just kind of the macro, although we will, but also diving into some strategies themselves, particularly, two things that I'm doing more actively now, just given some of the chaos and the nervousness that we have in the market today. So let's get started here. You should now be able to see my screen. Just move a couple controls around. And here we go. So it is, as I just said, February 24th. We are going to cover a couple overview things and then dive a little deeper into strategies. The first thing is let's talk about the sector head start. So this is literally just today. Where are we at today? Only a couple hours into the week. And what you're seeing here is pretty interesting. The reason that it's interesting is because we had a decent pop, nothing crazy over the weekend on the positive side, but about 0.5% on the Nasdaq, a little less on the SPY, actually about the same on the SPY to open. They were actually almost exactly the same. And then they started separating about an hour in. Now, what we saw, if you can see my screen here, is this light blue line shoot way down in the first half hour of the market. So this is technology. Technology shot down almost 2% over the course of about 25 minutes, which is a massive drop in technology. Now, one of the reasons, and by the way, you can look at technology with XLK, that's technology. So you can pull this up on an individual chart and look at it, XLK. And you can see that it started up a little bit on the day and then shot down about 2% in 25 minutes. Now, the reason that that's especially amazing regarding technology is because technology has such massive stocks in it. So, technology has Nvidia and Apple and these monster trillion plus market cap stocks in that. So to move 2% in 20 minutes or 25 minutes is a pretty extraordinary move. Couple that with the fact that a couple of the stocks, like Nvidia, started up 2.5%. Apple actually stayed up the whole time. It never even went negative, the biggest stock in the world. And yet XLK still ripped down negative 2%. Now, since then, it's actually rebounded. Now it's only down about, negative 35% or so, or 0.35%. So we've made back, 1.7% or something like that in those same stocks in just the next couple of hours. But you can see everything else dropped. Everything else, mirrored the same kind of thing that XLK did. But the extreme, the peak of the drop was much more aggressive here in XLK than anything else. So it's showing us that this is the sector that we're going to get the shakiest moves in. Not really surprising. I mean, technology has always been high volatility, kind of high chaos. But I think, we're going to be seeing over however much time it takes before technology really picks a direction, we're going to see outsized moves in both directions. We're not talking about like indecisive tight extraction. We're talking about really momentum and oversized moves in short windows. So this is something that I think is worth really paying attention to. A lot of times when the market is indecisive, it's contracted. Okay. So the market's trending, and then it gets indecisive and it contracts tightly, right? That's one version of indecisiveness. And then it either has to break down or it has to break up, just like any indecisive, which we're in the same situation here where we need to determine our direction, up or down. The difference is it's not a contraction indecisiveness. It's actually a volatility indecisiveness where we're getting big moves in both directions. So this is you can't trade those two types of indecision the same way. They're very different types of indecision. And I think when people, say, oh, we don't know which way the market's going, it's indecisive or whatever term they might use, they don't always recognize that there's different forms of that. And we're in a high volatility form of indecision. And so that should then impact the types of strategies that you use, which we'll talk about here in a moment. Before we get in there, earnings to watch this week, if I can spell the word week right, earnings to watch this week. A couple interesting ones. I mean, obviously, the big boy here is Nvidia. Should be one of the most exciting earnings that we have. It's the first earnings after that massive DeepSeek announcement where, Nvidia shed 17% in the course of a day, has rebounded since then, but been, very rocky. But that's going to be Wednesday after the close. Now, our plan is, just so you know, to mark your calendar for Wednesday, our plan is to actually all get together and trade those earnings live. So if you're following my Telegram or the Prosperity Pub Telegram or Graham, a couple of us, probably five of us, are going to get together and trade NVIDIA earnings all live together toward the end of the market. I think we're going to start like around 1:30 or 2 and go all the way through market close trading together. So again, just keep an eye on that. That's only happens a couple times a year, and it's the first time we've ever really all got together to trade it live because we think that this particular earnings with Nvidia is going to be extra interesting just because of all of the elements. So just keep that on your radar. Now, I also think Hims Hers, which is today, is going to be a really interesting one. This has been interesting stock, high volatility stock, high growth stock. But there's a couple things that have happened with Hims and Hers, which are the same company, two different websites, but same company. One of them being restrictions around which drugs they're allowed to sell. And obviously, if you're in the pharmaceutical industry and you have, a couple different drugs that make a mass proportion of your sales, and one of those gets taken off, it's going to impact your earnings pretty dramatically. Now, these updates are happening more recently, so they shouldn't really be affecting their Q4 earnings a whole lot. And obviously, we know that, medication in America today is at record levels. So it's very, very real possibility their Q4 earnings could be great. I mean, people are getting medicated at a higher clip than ever before. But what you might see, if they're honest in that earnings call, is you might see their forward guidance really get knocked down a few pegs if they're not selling Ozempic and some of the other big drugs. So that's an interesting one that happens today. Keep an eye, especially on the guidance, even more so than the Q4 numbers. And there's a couple other interesting ones in here as well. I mean, there's some boring, steady ones like Home Depot in the mix here. But Dell has been an interesting one. Still some question marks about how much market share they've picked up. Some financial ones, which, again, I think financial is a good opportunity to buy cheap right now. So some financial ones, but, the big boy is certainly NVIDIA. Kava, one of my favorite stocks that I stole from Graham, has underperformed since it had a crazy run. So curious to see how that one does on earnings as well. And Salesforce. Yeah, Salesforce should be an interesting one as well. Okay, now let me ask a question. Poll question. I need everyone's participation in the chat. Is anyone panicked by the current market? Give me an honest answer. Yes, no. In the chat, just be totally honest. And so I should see about 150 chats in here. Give me your okay. Yes, no, yes, yes. No, no, no. Yes, no. No, no. Yes, yes. Okay. All right, keep going. If you haven't hit the chat, hit the chat. Give me your answer. Oh wow, I wish I had the actual pool. I wasn't able to figure out how to do the actual pool in here, so I had to do it via chat. But we are right around 50-50. The poll question is anyone panicked by the current market? Someone asked. Okay. So we're getting a lot of yeses and maybe even slightly more no's, which I'm I'll have to go back and count them up, but it looks like maybe about 50-50. Well, from my point of view, I do get a little nervous when the market starts making irrational moves, like, up 0.5%, down 1.1%, back towards break even in the course of 3 hours. Also, the fact that in 2025, we've already had multiple moves on the major indexes of 3% plus. So that makes me nervous from a foundational standpoint of the way the market is moving. However, I do think the other side of the coin is really important, which is that the market still does look like this on a weekly chart. which I think is really important to remember. That's why I always tell people when you start getting nervous, when you start getting panicked, the first thing that you should do is just go look at your weekly and your monthly charts. That's really important, I think. Obviously there's short-term trading, there's active trading. I do a lot of that, but I think the first step you need to do is go back and take a look at your weekly and monthly charts and just see how do things look on those. And right now, like I said, don't get me wrong, I still have some nervousness around where we are, but I mean, this is a pretty darn good trend right now. This is still a pretty healthy market, and we haven't gone anything too crazy yet from a pullback standpoint. So I think the irrationality and the volatility is a little nerve wracking, but I think the structure of the market is still very far away from anything that starts confirming really deep pullbacks. I mean, we really need to see a lot more price action before we see that. So again, this is the weekly chart. And what I would say is that we're just in no man's land. And I'm going to talk about that a little more in detail. But really, we're kind of between this recent high, this recent low, and the all-time highs. We're just kind of cooking in here. But like I said, we're not kind of contracting on a day-to-day. We're seeing 2% moves, 1.5% moves. We're seeing nice big moves. And, if the market comes down and sits right here on the 500 level and then starts building back up, I think it's a pretty easy trade to trade it back to the upside. If it breaks and goes, I think it's a pretty easy trade to trade it, to the upside, furthering all-time highs. If we break below 500, head down, it's a nervous trade to trade it down, 50 points lower. But if we go back and forth week to week with aggression in between these two areas, then I think it's harder to trade, right? I think you're kind of stuck in that no man's land for a longer period of time. So the thing that I want to leave with you today is that, no man's land doesn't mean do nothing. When I say, hey, we're kind of here, we're not sure where to go yet, we're in no man's land, it doesn't mean do nothing. What it really means is shifting strategies to account for a more open-ended market. You always have to be prepared for the market to do something you don't expect. That goes without saying. That's every day, no matter what. But I think you have to be on extra alert in this scenario. The market could literally make a 3% move, and that won't even be that shocking in the scope of the last 2 months. And that is a different standard of an open-ended market. And so I think shifting and being aware of that is important. So there's two main things I'm doing right now that I am probably more active than I typically would be, just given, like I said, kind of the nervousness around the volatility. Not panicked about where the market sits fundamentally, because like I just showed you, it sits very good fundamentally from a just an uptrend standpoint, but just based on kind of the nervousness of the volatility and the way that we're moving and how short the cycles are, how short the rotations are. So the first one is using covered calls. And the second one is using pair trades. So for those of you, I mean, I know some of you are pros. You're totally familiar with this. You know exactly what I mean when I say this. And for others, this might be new territory. Now, we don't have time to get into the full strategy overview of the covered call approach, but I want to give you a few quick notes here for those of you, starting with kind of some very basic notes, and then a little bit more specifically on how I approach this. So for those of you who don't know, covered calls give you premium, or they give you the money of the option value by selling calls against the stocks you own. Okay, and the way that you can do this is you can sell one option contract for every 100 shares of the stock you own. Now, that's in a standard covered call. I'm not talking about synthetic covered calls or anything fancy. Just a standard covered call lets you sell one call for every 100 shares of the stock you own. Now, the lower the strike, the more premium you get. Okay, what does that mean? Well, it means if Apple is trading here at $240 a share, right? You could sell a $280 call way up here, and you're going to get almost nothing because that option is worth very little. Or you could sell a 242 call, and you're going to get quite a bit of value on it because it's very close. Or you could get really crazy and do some of those like kind of advanced hedges and sell a call even below the current price. I don't get into that. Some people do, but then your call would be even more valuable. So the call itself is going to be based on how close it is to the strike on any given stock. Now, if the option expires and the stock is below the strike, nothing happens. Nothing changes. The call expires. You keep the premium and nothing happens to your stock. If the option expires and the stock is above your strike price, those shares get called away at the value of the strike. Now, again, we don't have time to dig super deep into that. I don't mind doing a totally separate session sometime in the next few weeks to really walk you through this for those that are newer. But these are kind of the basic points that you'll want to know when it comes to covered calls of just very functionally how this works. Now, let's get into my advice. Number one, I only sell calls on stocks with high implied volatility because the risk to reward doesn't work otherwise. What do I mean by that? Well, I'm only going to sell calls on the stocks that have particularly expensive calls. Because if I go start selling calls on stocks that have low implied volatility, I'm going to really throw off the risk reward. I'm going to make a couple pennies. And then if that stock happens to make one nice outperformative move for me, I'm going to totally cap my gains on it by timing it poorly with a covered call. Whereas on a high volatility stock like coin, for example, I can get a really nice chunk of change on the premium itself that then makes it, valid for me to limit some of the upside because the price that I'm getting on those calls is worth it. So for me, some people ask, why not just sell a covered call on every single stock you own? It's kind of a no-lose situation. If the stock goes up, sure, it called away, but you'll have profit locked in. If it doesn't go anywhere, then you'll get, the premium and you'll keep the stock. Just do it on every single ticker you own, no matter what the price of the call is. The reason I don't do that is because a lot of stocks that I hold, let's say like boring stocks, even like Apple or Walmart or Exxon, for example, they're not going to give me good prices on the calls. And what they're actually going to do if Exxon moves 8% in a year, 12% in a year, it's going to make like a 4% move in 1 week and then do nothing, 51 weeks. And so on that week, I'm holding the stock all year long to get the value from that 1 week's move, basically. Why would I then cut that off by selling a covered call and get 0.2% or 0.5% even and take away the 1 week that it's going to move 4%? Versus coin, it's going to move 10% every darn month in different directions. So it's a lot easier to kind of validate, okay, I'm willing to kind of cap the gains in something like coin because the profit on the or the significance of the premium is worth it. So I don't do this as a rule across my portfolio. I only do it where the risk reward makes sense to me. And then on top of that, I only use a strike that I'd be happy to get called away on based on how I project the stock to perform. Well, what does that mean? It means even though holding coin, I could get really juicy and get much closer to the price and make a crazy amount of money on the premium. If the stock goes up, I'm going to be kicking myself because the whole reason I'm holding coin is because it has an outsized potential gain. And now I'm capping that down to a really low degree by getting too close to the current price. So for me, I'm only going to do it based on if it gets called away, it's going to be performance for the stock that's really good. So for example, on Friday, I sold 250 calls on coin. So that's basically saying coin's going to have to move 10% up for me in the course of 1 month because these are the March, 21 calls. So coin's going to have to go 10% up in 1 month for me to get called out. I can live with that. If my stock makes up 10% in 1 month, I can live with that. And so for me, that's kind of the basis that I use, where if I'm happy with the performance and the covered call is still worth enough, I'll do it. In this case, I got about $8,000 for coin just on premium. So this is just the covered call premium here, about $8,100. And that requires coin to go up 10%. So for me, that's a trade-off that makes a lot more sense. And so those are kind of the two basic pieces of advice. Number one, don't do it on every stock. You'll end up kind of averaging down your potential gains. And number two, make sure that you're going to do it where you're not going to be kicking yourself a week later if the stock starts to move in your favor. So I added covered calls to about half my portfolio last week because I was nervous about the market, right? I was not at the point where I think, oh, things are going down, I'm going to start trading to the downside. I wasn't taking any corrective moves. I don't really believe in hedges, like we're going to talk about in a second. But I was starting to say, oh man, if we're getting 2 and 3% moves in a single day, it just makes me a little bit nervous to have a lot of active trading and then really no premium generation. And so for me to do that, to kind of split the difference, I just did covered calls. And like I said, I did them in a way where if the stock moves up a lot, I'm good. No problems. Don't mind it. And if we rip into the full bullish mode, which is very possible, by the way, I'm not ruling that out at all, that by next week we can be at all-time highs in the NASDAQ and the SPY and ripping higher. I'm not ruling that out at all. So I'm going to cap some of my gains in that case, but I'm going to be totally fine with that. Now, one of the reasons I'm going to be totally fine if I cap my gains is because all of my active trading stuff will be performing really well. So on my buy and hold portfolio, if I start getting called out of some of this stuff that I did covered calls on because I capped my gains, sure, I'll miss a little bit of potential gain. But I'm also factoring in my entire trading basket. My entire approach is all factored in. And I know that if the market starts ripping higher, I'm going to be making a ton of money in my active trading. And that's going to help nullify the, capped gains that I get in my buy and hold portfolio. And for me, that's a true hedge. A true hedge is the using the way your strategies perform, not just holding on to something that eliminates your gains when the market goes down, or vice versa. So to me, that's why I'm totally fine starting to kind of roll into these covered calls, knowing I could cap my gains if we get a big run, but it's okay kind of in the grand scheme of how I look at all of my trading. Now, the other strategy I'm using that I mentioned more actively is pair trading. So this is when we buy a call on one stock and we buy a put on another stock that are correlated. So for example, we could buy a call on Exxon and we could buy a put on Chevron. Why? Because they're both energy stocks. They're both going to be correlated, and then we'll have one long and one short position. Well, if the energy market shoots up over the next month, there's a good chance that both of those stocks are going to go up, right? Like if you have a big surge in energy, what you'd expect is that both Chevron and Exxon move up together, not just one goes up and the other one goes down. So more than likely, our Chevron puts are going to be down, but our Exxon calls are going to be up. That's the basic formula of a pair trade. And so the key in creating pairs is that you want ones that are going to work out in your favor by getting the call to outperform in a bullish scenario and getting the put to outperform in a bearish scenario. And that's really the entire key. Okay, you really want to put yourself in a position where you're not just neutralizing all of the market moves, but you're actually setting yourself up for success by when the market goes up, the calls will outperform, and when the market goes down, the puts will outperform. And that combination is what gets you into consistency. So there's a few tricks to creating that balance and getting that right. We actually have about an 80% win rate on our official profit pairs trades, and we could talk about those today. We'll go through them in a little more detail here. But let me put a few of these pairs on your radar just to keep an eye on here over the next little while. Like I said, especially as we're in this high volatility framework that I think is probably not going away quite yet. So here's a couple that I like right now. Now, these are not necessarily ones that you go pull the trigger and trade right now, but there are ones that if you wanted to start getting into some or kind of use some trigger points, I often use like key levels as a trigger point where, if Apple breaks a key level, usually I just buy Apple. In this case, I might buy Apple and then also buy a put on Microsoft. So Apple long, Microsoft short. JPM long, BlackRock short. AbbVie long, Pfizer short. Meta long, Google short. This one's actually interesting. Most of these are more momentum. This one is actually taking a deeper pullback in Meta and trying to get kind of a value play out of it. And by the way, I think Meta is one interesting stock to consider right now. Just generally speaking, I don't usually call those Mag 7 stocks undervalued, and technically they're not. But I think Meta, there was an overcorrection there. I do still think it's the best Mag 7 stock right now, Meta and Apple. And so I think that's an interesting one just to keep an eye on, not just for the pair trade, but in general. Dex said UNH versus LLY. Dex, funny. That almost made this slide right here, but I just get a little nervous about UNH reverting to the mean there. I do like LLY right now. I was thinking about starting kind of that investing 2.0 approach on LLY this week. But UNH, I just figured there's probably a relatively high likelihood of some reversion to the mean there that could get you on the wrong side, even if the market weakened. And so I passed on including that, but it's funny that you mentioned that because it's exactly one that almost made my list today. But these are four that I think are just interesting, kind of to keep an eye on as we go forward. Where if the tech sector really rips, I have a hard time believing you're not going to be on the right side of this trade. If financial really rips, or if it collapses, I have a hard time you won't be on the right side. Same with health, and then obviously on communications as well. So I feel like easier said than done, but for the most part, these kind of put you in position where whether the market does rip higher or rip lower, you're going to have some outperforming and some high IB stocks here that could pay you. So, for example, I like Apple long, I like Microsoft short, but if we get another 2% plunge in tech, and this time Apple's leading the charge, so Apple's down 3%. I still think you're probably going to be okay more often than not because Microsoft is also going to be down, 2.5%. And those are the kind of pairs that I really like trading together, where kind of my worst case scenarios line up. Now remember, profit pairs is not a hedge in any traditional sense. Instead of capping our gains, it actually gives us unlimited upside in both directions, which is a very, very big difference that I think a lot of people miss out when they kind of think about hedging in traditional senses. We're not capping our gains. We're not doing one thing that will then cap out the potential of another thing. We're actually creating a scenario that gives us unlimited upside in both directions. Because for most people, they like the idea of protection, especially when the market's been insane, like it has lately. But we've all learned the hard way that traditional hedges, they don't really work out too well. Like 2022 is my favorite example of this. If you were holding TLT in 2022, hoping the bonds would be a good hedge that your financial advisor suggested, didn't work out too well. And then even gold in 2022 actually finished lower, which has obviously kind of been the traditional hedge for decades. And so it just goes to show you that traditional hedge is not necessarily going to protect you, but certainly not going to make up for lost ground in your portfolio. And that's why I invented profit pairs, because I really wanted to have some protection, but I wanted something that wasn't going to cap my gains and then maybe 50-50 protect, some of my losses, but actually give me true upside. So let me give an example of how this actually works in real markets. I just talked about going up, going down. Let me give you an example. So this was September, and I was looking at the financial sector because, as you guys know, I like the financial sector. Whenever it gains momentum, I really enjoy trading financials, and I really liked it once again as kind of an undervalued sector. But we had just seen the bottom fall out twice in the previous 5 weeks. So this is going back to 2024. You guys remember we had that both July and August crazy dips in the market. So obviously I was pretty nervous, kind of like I'm mentioning today. And so I used profit pairs. Now with profit pairs, we're using basic level one options, nothing crazy here, using a call on one financial stock and a put on the other financials. So we're protected from a fallout, but we have upside in both directions. In this case, I was using Citi and Visa. Okay, so notice they're both financial stocks, right? I want to trade financial sector, so I'm picking both financial stocks. Now, I ended up being totally wrong about XLF. Financial sector sold off hard. Literally the very next day, we got like a 2.1% correction on XLF, so it ripped down pretty hard. And if I had been trading any normal strategy, like, hey, let me just go long and let me put a debit spread in and let me buy some XLF, obviously that would have worked out very, very badly for me as the financial sector ripped down. But we used the profit pair and we actually netted $5,800 or 58.33%. And that was actually in one day, which is much shorter than a usual profit pair lasts. But what you can see here, I think this is super important. So I was long Citi and I was short Visa. It's not like Citi went up and Visa went down. I didn't hit the perfect profit pair. I wasn't right on one side and then wrong on the other side, or right on the other side where my call made money, my put made money. As you can see, they both went down, right? Which is kind of what you'd expect with the financial sector collapsing. So that's more often the case. It's not that, we hit one or we get this divergence exactly right. We get enough divergence where we make between the two positions. So another great example of this was last summer, right in the middle of that crashing and burning that I just mentioned. So this was July 16th through 25th when the market dropped 7% in 1 week. Anyone remember that beautiful week? You thought Friday was bad. That was ugly. Now our profit pair actually turned around and made 101% while the market was down 7%. Why? Well, because we had a put on, right? So we had a put on one of the tech stocks. It ripped straight down. And so net combined, we had a huge return on the profit pair. Or beginning of the year, so this is when the market was going higher, the S&P was up 3%, and their profit pair cranked out at 99.8%. Why this time? Well, because we had calls, right? So when the market's ripping and you got calls, that's good. When the market's crashing and you got puts, that's good as long as they're overcoming the other side of the trade, right? That's the whole point of the profit pair. Now, here's a really important distinction that I think most people miss. What about when the market's dead flat? Well, we actually had this happen pretty recently where the S&P was literally dead flat for the entire week, made 0.2%. And that week, the profit pair still generated a nice 49.3% return. Okay? Up, down, or sideways, it doesn't really matter. Now, what do I mean by that? Well, what I mean is if the market's collapsing, right, you need your put to outperform. So you need to make a put that goes up, plus 200%, and then your call is down 90%, and together they equal a profit. When the market's ripping higher, same thing, right? You need your call to be up 200%, and maybe your put's down 90%, right? But combined, they still make a nice profit. And when the market's sideways, and this is the one that most people miss, what you need there is you need the strong stock to kind of continue grinding up, and maybe it makes 20%. And you need your weak stock to kind of continue grinding down in a net neutral, all things equal, and maybe it makes 20%. Okay, and then you're profitable that way. So you really need to pair these in a way that sets you up for those conditions where up, down, or sideways, you still have a position, or a chance to win. It doesn't mean you win every time, obviously, but you put yourself in the right pairs where you have a chance to win in all those conditions. Now, the key here is actually very straightforward, as I'm sure you guys already know. What we're doing is we're trading these paired stocks in two different directions at the same time. So if we buy a call on Lowe's and we buy a put on Home Depot, right? Two correlated stocks. One you have the call on, one you have the put on. And then when it shows up on the chart where Lowe's outperforms Home Depot, and that's when you have the call on, the gap between those two relative returns is your profit potential. And that's the entire profit pair, which is why we call them profit pairs, because the divergence between the two pairs is what you get as profit potential. So take a look at AVGO and Oracle. This is a really great example. So AVGO was by far the stronger stock. Oracle was fading quite a bit. So the difference in the relative performance of those two assets is where we make our money, right? Because if one's down 100% and one's up 100%, we don't make anything. If one's up 50% and one's down 50%, we don't make anything. We need one to outperform or for them both to perform separately. So in this case, Oracle and AVGO put together about an 83.7% gain in 7 days. So pretty good return, again, for, considering that you're protected on both sides. Or here's actually one of my favorite examples. This is Valero and Williams. So this would be the example of like trading Exxon and Chevron. This is going all the way back to 2022 because we tested this, by the way, going further back than that, where VLO was really picking up steam, WMB was cratering, and on the chart itself, you got a really big gap. And that's rare for energies. You don't normally see two closely linked energy stocks make a gap that big. In this case, would have paid at about 234% using our standard option criteria in 9 days. Now, I think that's really important, that the potential to make 234%, okay? Obviously, 5K turns into about $16,705. Now, again, huge return, definitely not a typical result for profit pairs, but I do think it's really important to point out why. Because part of profit pairs isn't just to grind out week after week winners. I mean, that's part of it. You want to grind out consistently. Like this, my very next slide says, usually kind of a more typical result would be, 20 to 30% in a week. Market doesn't do anything too crazy, right? So you're kind of grinding out 20 to 30% winners. But you need to have the potential for those big, crazy, juicy winners because if the market collapses, that's part of the whole reason you have this strategy, right? So for example, if you make 20 to 30% on an active trading and the market collapses, it goes down 5% in a week, you're going to be losing 100% on lots of other strategies. So you need this to make up a lot more than 20 or 30%. And that's the beauty of it. It's not capped. It could make 300% on the week that your market collapses on you. So that is a really important part not to overlook on profit pairs, is that it's both designed to help churn out, those nice steady gains, but also part of the whole point it exists is so that it can legitimately make up for when the market collapses on you. Because you don't want to be stuck where you're holding a couple bonds and sure that maybe they make a couple percent or gold makes a couple percent and it barely hedges you. No, no, no. You want something that can dramatically outperform and start to make up for, your directional strategies that might be down. So that's really important. The cool thing is here, we're protected the entire way. Like March, CRM, ACN, same thing. CRM moving, ACN slowing. Buy a call on CRM, buy a put on ACN. Our expectation was that CRM would go up, right? That was the whole point. Instead, the entire tech sector fell off a cliff. This is exactly what I'm talking about. So if anyone's trading directionally, you're in for a world of hurt because you would have been bullish on the tech sector. But if you're trading the profit pair, the two positions combined for a net return. That's including the fact that, one side is losing. They combine for a net return of 117%, enough to turn 5K into over 10 grand, even when you were actually wrong on the direction. But it's really important to understand we're not just buying calls on any stock and buying puts on any other stock, right? It only works because these stocks are paired. Like, for example, ISRG and ABT. This pair was a beautiful trade, but it only works because they're both healthcare stocks. If they're not both healthcare stocks, then I'm not actually protecting myself at all. So when the healthcare sector went on a massive run up, I already had the call option on a strong healthcare stock, right? I was already protected. I was already planned. That was already baked into the strategy. Now, if the healthcare sector would have instead have collapsed, well, I would have had put options on a weak healthcare stock. And the best part about this is that we get a new opportunity every week. So this is not a once in a blue moon. Like I was just saying, the idea here is to grind out week in and week out while always being ready for those big, crazy moves. By the way, our very next profit pair trade is firing off tomorrow. I do this very systematically on Tuesdays because I built a whole mechanical strategy for how to trade profit pairs. So if you want to get in on the action, let me just give you the short pitch on why you should join profit pairs. I won't take too much extra time here, just a couple minutes, let you know what profit pairs is as a service, how you can join, and how you can take advantage of our next alert coming tomorrow. So with volatility as hectic as it is right now, I think it's a great time to have this in your arsenal. Like I said, it's one of the two things that I'm starting to do a lot more actively. And so how it works, first, you get the weekly profit pair trade. So every week, I give you my best profit pair. You'll get the write-up, why we're taking it, how it works, all that good stuff. And then you'll get the exact entry and exit details, the option criteria, the pricing, how they go together, how to put them in the pair, how to build the pair with the right risk management. All of that is inside the alert. You also get Telegram and SMS alerts, of course. Just, we always make sure that those go out so you don't miss any trades. And typically, one of the nice things about profit pairs is you have about 24 hours to get into the trade because they're synced up. They're moving together. So you have more time to get into the trade. And like I said, to make it really easy to manage, I send these out right around the same time each week. So right around 10 to 11 a.m. Eastern each week is when the profit pair comes out because I built the whole strategy just to try to make it systematic and simple because that's how I need to trade in order for it to work for my life. So that's how most of my strategies work. Looks just like this. You get an email, you get an alert. Just like Amazon versus Target, great pair here. They are correlated in the long term, but they often have divergence in the short term, so they make for great pairs. In this case, we did a call on Amazon and a put on Target, right? Same thing. Retail goes up, you've got your call. Retail collapses, you've got your put. And it would have taken about 4 clicks to set up that trade. Again, this is level 1 basic options. In this case, just a nice steady grinder, about 31% in 5 days on that trade. About $1,586 if you're using, a standard 5K stake on that trade. So when you log in to grab the next alert tomorrow, you'll also see the trade tracker. And this is where you can go through all of the recent trades. I was sharing with our team recently, profit pairs has kind of been funny because in this volatility, you would think we would lose more and we'd hit bigger winners. In fact, it's kind of been the opposite. We've actually gotten surges one direction, take a profit. Surges the other direction, take a profit. So we've been hitting more of those 20, 30% winners, but our win rate has skyrocketed up to about 80%. And by the way, if you want to go a little deeper than we were able to get into today, you can go through the workshop. So this is an entire, about an hour-long workshop that goes through all the details. I actually charged money for this. I know some of you in here paid and joined that class. But if you want to take advantage of that, it's actually free inside the members area. So you can go through. I even have the PowerPoint in there. So you can flip through the PowerPoint kind of one slide at a time and go through that as well if you'd like. Now, if you know me, I also love live trading these as often as I can. We might do one Friday, by the way, as a live trade. We'll see how the market shakes up. But I'm also going to do as many live profit pair trades as I can throughout the year. I try to do them as much as I can. So, that way you can see me do it in real time, set it up with real money on my brokerage account. And if you have any questions, how do these work? How do I set up the risk management? Obviously, you have unlimited customer support, no issues there. Just call our team. They're US based. They understand how profit pairs works. And so you can call them anytime because for a lot of people, they've really never traded the profit pair style before. And so it's a whole new world. So go through the strategy guide, go through the trade tracker, use our support team if you need to. But that way you have everything you need to trade these strategies. At least 52 trades, the strategy, the workshop, live trade rooms, all that good stuff is in there. And just to help you get in today, before our next trade, I'm going to extend our biggest discount ever on profit pairs today during our Mapping the Market session. Keep in mind, our test shows that the expectancy over 1 year of trading is about $82,498 with 5K in each position. So it's a pretty dramatic profit factor on profit pairs, about as positive of an expectancy as you can get. And the reason is because it is pretty good at churning out those steady gains. And then where other strategies go into drawdown on big market pullbacks, profit pairs often has its biggest wins during those periods of time. So north of $6,874 per month based on the 5K stake is kind of what we've tested out as the expectancy. And so we initially priced profit pairs accordingly, about $29.97 a year. Again, incredible win rate, incredible profit factor, easily worth $29.97 if you ask me. If you're a serious trader and you want something that's kind of a rock solid addition to your portfolio. But today it's at the steepest discount we've ever offered. You can get in for $12.46 for the entire year. So that's 52 opportunities. That's the training. That's everything. $12.46, less than the $14.97 that we cut it in half of before, just $12.46. Again, that's less than the expectancy of a single trade you get the entire year for. So you'll get 52 opportunities, all the good stuff. If you want to grab it, if you want to take advantage and get in before our trade tomorrow, it's prosperitypub.com/PPA. That's profit pairs, PPA. You can jump in today. You can call our team 904-706-3537. They can lock you in. Just make sure you tell them that you want the discount of the $12.46 discount because otherwise they might not know what the price is. So just make sure you tell them. As soon as you get through the order form, that's where you'll get access. Obviously, it's all in the one-click trading, like all my other stuff. Trade tracker, recent opportunities, all of that is in there for you now. You'll get the trade alerts, you'll get the strategy, the live trade tracker, plus some bonuses that I didn't even have time because I just did kind of a quick and dirty version of it today. So Jump in. Of course, like I said, unlimited customer support as well. Just click the link in the chat or you can call our team. Let me cover a couple of the questions I always get about profit pairs. And then if you guys have any additional questions, I'll jump into the chat as well for those. So, what level of options? Just level one. Basic calls and puts are all we're using here. How much capital do you need? Probably about $1,000. The average trade might be 600 or $700. So playing for $1,000 for any given trade, and maybe a couple grand to be able to trade it actively. Can you do it in a retirement account? Yes, just need to have level one option permissions. What is the win rate? Well, it's actually about 80%, which is even a little higher than we're even shooting for, because we've seen kind of these quicker snapbacks. And so we've taken more of those kind of 15, 20, 30% wins versus a lot of the big wins. We still plan to have them, obviously. And by all means, if the market collapses, I'll be happy that I have a strategy that has unlimited potential. But right now, it's been very consistent. Average win is going to be about 40% if you go through the whole track record. But like I said, different seasons are going to have different kind of typical returns. So if the market's just kind of grinding slowly, you're probably going to have more 15, 20% wins. If you're getting the market, collapsing like it did in August or July, where it drops 8% in 2 weeks, well, in that case, you're probably going to get, 100% win and 180% win and a 250% win that blend up that average win. So it's going to depend somewhat on the market conditions. Average loss is typically going to be, 60 to 70%. Sometimes we just go ahead and let it expire, take a full 100% loss. But, if it's not going anywhere, we just want to get out of it. We'll save up some time and do that. So average net result, like I showed you, the average result has been really good. It's been about 35%. If you go through the entire track record, which is crazy because that's like what we're average winning right now. But if you go through the entire track record, that's about the average net result. Average hold time, 7 to 10 days. Profit factor, over 3 on profit pairs, which again, about as good as it gets, especially for trading both directions at the same time. Are we always hedged? Yes, we close and open the positions at the same time. So throughout the entire position, we are hedged. Do we own multiple trades at once? Yeah, we can. If we need to give it 7, 10, 12, 15 days, we'll add another one and we'll keep that open. Other long-term plays that I have for these, like I shared, I really like Apple and Microsoft. I think that Meta versus Google is an interesting one, and then a couple others as well. So you can get in 1246 for a full year right now, prosperitypub.com/PPA. Hope you guys take advantage of that before we kick it into high gear tomorrow with a new opportunity. Yeah, win rate has been really high. Like I said, the last couple months, I don't even want it to be that high because I'd rather get some more of those, crazy big moves worked into the mix, to be fully honest with you. But we take what the market gives us. It's another great reason of kind of having that hedge at all times. Again, I use the word hedge, not really a hedge, but having that pair at all times where you can just kind of shift with what the market gives you. And yes, this will be recorded. You can even go to it on YouTube immediately if you want to do that as well. So you can watch the full recording, the couple of trades that I gave out today, a couple of the strategies we talked about. Like I said, profit pairs is something I'm doing a little more actively. When the market starts acting like this, it's one of the strategies I really like to lean into. I'm sure some of you guys traded the QQQ and the SPY pair trades that we did. Recently, when the market was more chaotic, some of those worked out really, really well. And so it just gives you an opportunity to feel a little more comfortable in these kind of conditions where you could see a 2 or 3% move on any given day, knowing, hey, I'm set up for that, and I have it baked into my strategy. So, yep, just go to prosperitypub.com/PPA. When you click that link, it just opens up this here order form, and you got this special discount locked in for you right there. 1246 gives you the entire year. That's 52 trades. It's the strategy guide. It's all the good stuff in there for much less than even half of the original price on profit pairs. Rob, I'm not sure I understand. Not sure I understand your chat. Something total invested 82,000, a fifth of that. think you're asking something about the stacking of the ROI, but I didn't quite. So our typical trade, Rob, would be about 30%. So if you're putting in, like $1,000 on a trade, you would look to make 300 bucks. But I am careful because with profit pairs, the range is pretty extreme. We'll have some break even trades. We'll have a lot of, 30, 25% trades. And then you'll have some of those 200% trades where the market really goes nuts. And obviously that's a key part of the strategy. So it has the widest range of outcomes of really anything that I trade. And 25, 30% on kind of a standard trade is great, but you want to have that availability to hit those really big winners when the market shakes up. And so we set up a trade every week, and that way, on any given week, if the market does something crazy, you have a position on. So I always have a position open on profit pairs essentially. Yes, the $82,000 kind of annual expectancy would be based on 5K per trade. So the 1586 average win, and all that is all based on if you're using 5K per position. Jim, great question about pairing stocks in different sectors. I can't say that I've fully tested all of the variations, but I started out with something a little more similar to that, where I was taking essentially strong sector from strong or strong stock from strong sector and weak stock from weak sector. Not exactly that, but more similar to that. I was using a couple other metrics to get to that idea. The problem was too much reversion to the mean. So too many times where the strong stock sector got weak, the weak sector got strong, they reverted, they kind of crisscrossed over the course of the year, and then you just found yourself on the wrong side of both too often. Was the big challenge I ran into there. Whereas if you trade truly correlated, it doesn't matter if it reverts to the mean. You take the strongest sector and you have stocks, both your stocks from that sector, and that sector goes from the strongest sector to the weakest sector, which happens more often than you'd think. Well, now both of your positions are in that sector, and now you have a put within the sector that's collapsing. So that's why I ultimately ended up building the strategy around that approach. Sydney, good question. I'm sure we could create that. Sydney asked if we could create like a trade tracker template so people could put their own entries, exits, and track them themselves. That's a great idea. I'm sure we could do that pretty easily for you. I'll make a note there. Student trade tracker. Because yeah, I think that would be fairly easy to create and then have one that's just you can download and edit yourself, and then it'll populate all the data for you. Cool. All right. Well, thank you, everyone. Appreciate you jumping on, as always, on these Monday sessions. We've been going a little bit longer than I planned. These are supposed to be really quick hitting, 30-minute segments. I think our average has been an hour so far, so I've been long-winded, but appreciate you guys. Hope you have a great rest of your day and a great rest of the week. And for all of our sakes, I hope this market does some good things for us. By the way, Q's all the way, back down to 0.5% down, and SPY back to break even. Just the madness continues, but should be a lot of fun and interesting to trade. And I think profit pairs are a good opportunity to do it. So, see y'all.